All right, let's dive right in. Welcome to this explainer of Knight-Swift's Q2 2026 earnings report. Today, we're decoding the massive numbers and the strategic maneuvering behind North America's absolute largest full truckload fleet. Look, if you follow the logistics sector, you know the freight market has been wild lately. And Knight-Swift's latest results, they give us the perfect window into exactly how the biggest players are navigating these turbulent waters.
Here is our roadmap for today. We're going to hit the big Q2 finish, the shifting market wins, truckload and intermodal triumphs, how they're navigating LTL and logistics, and finally, the road ahead.
Let's kick things off with Section 1, the big Q2 finish and those headline numbers.
The year-over-year improvement here is honestly pretty stark. Knight-Swift posted an incredible 80% jump in adjusted earnings per share. They hit 63 cents per share, which is a massive leap compared to just 35 cents in the exact same quarter last year. If you're an investor, this is exactly the kind of bottom-line explosion you're looking for, right? It tells you that something fundamental has shifted, both in their operating environment and, more importantly, in their execution.
And it wasn't just the bottom line either. This earnings surge was powered by 12.6% growth in total revenue. That pushed the consolidated top line up to a whopping $2.1 billion for the quarter ending June 30, 2026, up from $1.86 billion in Q2 of 2025. You know, it's one thing to cut costs to boost earnings, but when you pair it with double-digit revenue growth at a multi-billion-dollar scale, you are literally firing on all cylinders.
Moving on to Section 2, shifting market wins and the macro tailwinds.
So how exactly did they hit these numbers? Well, let's look at what CEO Adam Miller had to say. He pointed out that the second quarter saw a continued and rapid progression in truckload market conditions. He specifically called out a supply-driven tightening that pushed spot rates, tender rejection rates, and contractual negotiations higher as the quarter went on. This is a super crucial piece of context. The market tightened rapidly, and Knight-Swift perfectly positioned its immense over-the-road scale and agility to capture that yield.
Now, a really crucial point here revolves around tender rejection rates. As a quick refresher, the tender rejection rate is exactly what it sounds like. It's the rate at which carriers turn down freight shipments. A high rate acts as a proxy for market demand significantly outpacing available supply. Adam Miller noted that Knight-Swift's tender rejection rates were running at roughly twice the levels of public indicators during Q2. This brilliantly illustrates just how heavily demand for their specific reliable services is outpacing the broader market. Shippers desperately want their freight moved, and they're turning to the biggest, most dependable players first.
But why is supply so tight in the first place? Well, this tightening is fundamentally driven by a shortage in driver availability. Safe, quality professional drivers are becoming a massive premium asset. Honestly, they're getting harder to find than a cheap parking spot in Manhattan. Knight-Swift is deeply aware of this. They are intensely protecting their driving associates and leveraging their industry-leading academy network. They're making absolutely sure they have the talent to keep those trucks moving, especially while competitors might be struggling to even seat their cabs.
All right, on to Section 3, truckload and intermodal triumphs, looking at their core strengths. The truckload segment, which is really their bread and butter, saw its adjusted operating ratio improve to 91.0%, meaning it cost them 91 cents to make a dollar. That is a solid 360 basis point improvement year over year. Meanwhile, the intermodal segment just put up staggering growth numbers. Intermodal revenues spiked a massive 34.9% year over year, and that was driven by an incredible 19.6% jump in load count, marking their highest second quarter mark since 2021.
A huge part of this came down to strictly managing their network efficiency. They managed to reduce non-paid empty miles by 140 basis points. Think about that for a second. That means fewer empty trucks out there burning expensive diesel without actually making a dime. This hyper-disciplined network management directly amplified their margin, driving a 5.5% improvement in revenue per loaded mile. It's basically a perfect example of how intense operational focus converts market opportunities directly into hard earnings.
And man, we absolutely cannot talk about the truckload segment without highlighting the U.S. Express integration. A crowning achievement this quarter was the U.S. Express over-the-road division hitting its very first profitable quarter since Knight-Swift acquired it. They are actually making strides with greater rate improvement than the legacy brands. This is literally a masterclass in acquisition integration and cost control. They took the most challenged part of that business and turned it green right in the middle of a strengthening market.
Next up, Section 4, navigating LTL and logistics and dealing with strategic friction.
Over in the logistics segment, we see a really fascinating strategic contrast.
Revenue per load skyrocketed by nearly 30%, but load count actually declined by 16.4%. They intentionally let go of low-margin volume. They're maintaining a fiercely disciplined approach, actively prioritizing carrier quality and profitability over sheer volume.
Now, they had to make this trade-off because escalating spot capacity costs were seriously squeezing their margins. With industry capacity reducing, the cost of purchased transportation went up faster than their contractual pricing gains. On top of that, they enforced rigorous third-party carrier screening, which further pressured gross margins down to 15.4%. But you know, this is a great lesson in business discipline. They consciously chose margin protection and quality over chasing unprofitable freight.
The less-than-truckload, or LTL, segment followed a very similar story. Shipments per day actually decreased by 3.7%. Why? Well, because management deliberately metered volume to improve their overall freight mix and network efficiency. And guess what? It worked. Tonnage per day grew, weight per shipment grew, and their adjusted operating ratio improved. They are essentially pruning the tree to make it grow stronger.
Finally, Section 5, the road ahead, Q3 guidance, and beyond.
So where is Knight-Swift steering this massive ship as we look into Q3 and the rest of 2026? Well, their guidance is highly optimistic. They project adjusted EPS to land somewhere between 71 and 77 cents. This assumes that industry capacity remains pressured and that demand stays stable across their core markets, following typical seasonal patterns. They're also expecting truckload revenue to continue climbing in the mid-single digits year over year, and intermodal revenue to keep pushing up in the low single digits sequentially.
And to support all this ongoing growth and efficiency, they are putting their money where their mouth is. They're committing between $600 and $650 million in net cash capital expenditures for the full year of 2026. This isn't just basic maintenance. This is aggressive investment to upgrade their tractor and trailer fleet, enhance driver amenities, push their technology forward, and expand their terminal network. They are basically building a fortress.
Which leaves us with this final, crucial question. As driver supply tightens across the industry, and as contract rates continue to predictably reset higher to match spot market pressure, is the North American freight market entering a new, golden era for massive, highly efficient, asset-based carriers like Knight-Swift? When you combine their operational discipline, that successful U.S. Express turnaround, and their sheer, massive scale against the backdrop of tight supply, they seem perfectly positioned to dominate. It's a fascinating space to watch, and we'll be right here to explain their next move. Thanks for joining me on this explainer, and keep learning.